It's Saturday evening, January 18th, 2026, and if you blinked on Thursday and Friday this week, you missed the beginning of what I believe will be the single most explosive move in the silver mining sector in over a decade. I'm a private commodities analyst. I've been trading physical silver and mining equities for 12 years. I built this channel using this AI avatar for one reason: speed. I refuse to wait half a day for mainstream outlets to spin the narrative when I can give you the raw data in real time. And frankly, I'm tired of watching AI hype channels pump out recycled garbage when retail investors need actual information. So here's what just happened. Thursday, January 16th, monthly options expiration, OPEX, the day I told you to watch, the day when billions of dollars in derivative positions either print money or explode. And something broke, not the silver price. The silver price actually held $90 through the entire session, closed at 91.73, exactly where it needed to be to inflict maximum damage on the institutional short sellers. But here's what broke. The suppression mechanism, the invisible anchor that has been holding silver miners underwater for months, finally snapped. And on Friday, January 17th, we got the confirmation. SIL, the silver miners ETF, exploded 8.3% in a single session, while silver itself only moved 2.1%. Let me say that again. The miners moved 4 times faster than the underlying metal. That is not normal price action. That is not a coincidence. That is the beginning of the catch-up rally I've been telling you was mathematically inevitable. And here's why this matters. Right now, tonight, as you're watching this, there are hedge funds, prime brokers, and institutional desks scrambling because the gamma squeeze they thought they had contained just went critical. The call options they sold, thinking they would expire worthless, went deep in the money. And now they have to deliver the shares. They have to buy the stock. And when they start buying, they're going to trigger more buying. And that's going to trigger algorithms. And those algorithms are going to trigger stop losses on short positions. And those stop losses are going to create a self-reinforcing feedback loop that doesn't stop until the miners have repriced to reflect reality instead of suppression. Here's my primary claim. And I'm going to spend the next 30 minutes proving it to you with data, math, and real market mechanics. The post-OPEX explosion in silver miners is not a one-day event. It's the beginning of a multi-week gamma squeeze that will force a complete revaluation of the sector. The operating leverage trap I warned you about has been sprung. And the institutions that fought so hard to keep the lid on this pressure cooker are about to learn a very expensive lesson. Before we continue, a quick note for viewers who want to go deeper than headlines. I've put together a short educational guide called the Silver Insider Toolkit. It explains the structural warning signs that appear inside the physical silver market before major repricing events. Things like COMEX inventory shifts, futures curve behavior, delivery stress, and government policy changes. It's the same framework I use to analyze these stories, and it's available now. You'll find the link in the description. Let me give you the snapshot from Friday's close. I pulled this data at 4:15 p.m. Eastern. Stop for a second. Look at the math. Silver is up 2.1% on Friday. The miners are up 8.3%. That's a 3.95 to 1 leverage ratio. But here's the thing. At current silver prices, the operating leverage should be even higher. The math says miners should be moving 5 to 1 or 6 to 1 relative to silver, which means Friday's move, as impressive as it looks, is still only the beginning. We haven't even reached the full leverage potential yet. And that's what I'm positioning for. Now, before we go further, let me address what happened on Thursday during OPEX. Because understanding Thursday is the key to understanding why Friday exploded and why next week is going to be even more violent. Thursday, January 16th, the market opened and immediately silver got hit. We saw a flash dump at 9:47 a.m. Eastern. Silver dropped from $91.30 to $89.15 in less than 10 minutes. That's a $2.15 drop, a 2.4% move. Classic stop-loss raid, classic OPEX suppression. They were trying to pin silver below 90 to keep all the 90 call options out of the money. And for about 90 minutes, it looked like it was working. Silver was trading in the $80 range. The miners were flat to down. The media was silent. But then something changed. At 11:30 a.m., buying started. Not retail buying. This was institutional size. Block trades. 100,000 share orders in SIL. Multi-million-dollar orders hitting the tape. And by 1 p.m., silver had recovered back above $91. By the close, we were at $91.73, above the key $90 strike. And that meant every call option at $90, $85, $80, all the way down, was now in the money. Billions of dollars in notional exposure just went from worthless to valuable in a matter of hours. Here's what that means in practical terms. When you sell a call option, you're making a bet that the stock or commodity will stay below a certain price. If it stays below, you keep the premium and the option expires worthless. But if it goes above, you have to deliver the shares at the strike price. And if you don't own the shares, you have to go into the market and buy them. That's called being short gamma. And when a lot of market makers are short gamma at the same strike price, and the price crosses above that strike, you get a gamma squeeze. Everyone has to buy at the same time, and that buying pushes the price higher, which triggers more options, which forces more buying. It's a doom loop for the shorts. And Friday, January 17th was day one of that squeeze. Let me show you the mechanics of what's happening right now. This is the part most retail investors don't understand. And it's the part that makes this opportunity so explosive. When silver closed above $90 on Thursday, the delta on all those call options changed. Delta is the sensitivity of the option price to the underlying stock price. An out-of-the-money option has a low delta, maybe 0.2 or 0.3. That means the market maker only has to hedge 20 or 30% of the position. But when the option goes in the money, the delta increases. It goes to 0.6, 0.7, 0.8. That means the market maker has to hedge 60, 70, 80% of the position. So if a market maker sold 10,000 call options on SIL at the $14 strike, thinking silver would stay below $90, and the options would expire worthless. They only needed to hedge 2,000 or 3,000 shares. But when silver crossed $90 and those options went in the money, suddenly they need to hedge 7,000 or 8,000 shares. That's 5,000 shares they have to buy. And they have to buy it now, not next week, not when it's convenient. Now, multiply that across every market maker, every hedge fund, every institutional desk that was short these options, and you're talking about tens of millions of shares that have to be bought in a very short window. That's the gamma squeeze. That's the forced buying event. And here's the beautiful part. The market makers can't just decide not to buy. They have risk management systems. They have compliance departments. They have regulators watching. If they don't hedge their delta, they're exposed to catastrophic losses if the stock keeps running. So they have to buy. And when they buy, they push the price higher. And when the price goes higher, more options go in the money, and the cycle repeats. This is what happened on Friday. And this is what I believe is going to continue all next week. Now let me show you the operating leverage math one more time. Because if you don't understand this, you won't understand why Friday's 8.3% move is just the appetizer. Silver is trading at $93.67 right now. The average all-in sustaining cost for the major silver miners is approximately $32 per ounce. That's what it costs them to pull silver out of the ground, refine it, transport it, and bring it to market. Let's run the profit margin calculation. Profit margin equals price minus cost divided by price. At $93.67, silver with $32 AISC, the margin is 61.67 divided by $93.67, which equals 65.8%. Now, let's go back to early 2024 for comparison. In January 2024, silver was trading at $24. At $24 silver with $30 AISC, costs have gone up slightly, the margin was negative $6 divided by $24. They were losing money on every ounce. Many miners were literally operating at a loss, burning through cash, taking on debt, just to stay alive. Fast forward to today. At $93.67, these same companies are printing 66% margins. Their profitability didn't just double, it didn't triple. It went from negative to 66% positive. That's an infinite percentage increase if you want to get technical about it. And yet, the stock prices are barely higher than they were in 2024. Let me give you a specific example. Hecla Mining, ticker HL, in January 2024, the stock was trading at $4.20. Today, after Friday's 11.2% surge, it's trading at $6.85. That's a 63% increase in the stock price, but silver went from $24 to $93.67. That's a 290% increase in the underlying commodity. The stock moved 63%, the commodity moved 290%. That's a 4.6 to 1 gap. The stock should have moved 4.6 times more than it did. Where did that value go? It didn't disappear. It's still there. It's coiled up in the balance sheet. It's sitting in the earnings reports. It's waiting to be recognized by the market. And here's the catalyst. Next week, in the final week of January, we're going to start seeing Q4 2025 earnings releases. Hecla reports on January 28th. First Majestic reports on January 30th. And those earnings are going to be spectacular. We're talking record revenues, record free cash flow, record profit margins. And when those numbers hit the tape, when the analysts have to update their models, when the institutional investors see the actual results, they're going to have to re-rate these stocks. Because right now, they're priced as if silver is at $40, but silver is at $94. And the earnings are going to prove it. Now, let me address the skeptics. Because I know there are people watching this saying, this sounds too good to be true. What's the catch? Skeptic argument number one. Costs are rising just as fast as the silver price. These miners aren't actually making money because inflation is eating their margins. Here's my rebuttal. Yes, costs have risen. Diesel is more expensive. Labor is more expensive. Equipment is more expensive. But they haven't tripled. I've been tracking this. AISC for the major miners has gone from about 28 per ounce in early 2024 to about 32 per ounce today. That's a 14% increase. Silver has gone from $24 to $94. That's a 290% increase. The cost inflation is real, but it's utterly dwarfed by the price appreciation. The math is not ambiguous. These companies are printing money. Skeptic argument number 2. The miners will get hit with windfall taxes. Governments will take all the profits. This is a favorite fear among precious metals skeptics. And it's not completely unfounded. We've seen resource nationalism before. We've seen governments in developing countries change the rules and seize mining assets. But here's what the bears miss. First, the time lag. Governments are slow. By the time they draft the legislation, debate it, pass it, and implement it, the stock will have already doubled or tripled. You can take your profits and move on. Second, diversification. The major silver miners, ETF, SIL, holds companies across multiple jurisdictions: Canada, United States, Mexico, Peru, Australia. If one government gets greedy, the other operations keep running. Third, not all miners are in risky jurisdictions. Hecla Mining operates primarily in the United States. Kerr operates in the US and Canada. These are Tier 1 jurisdictions with stable legal frameworks. The windfall tax risk is priced in. That's why these stocks are so cheap. That's the opportunity. Skeptic argument number 3. The banks will never let it happen. They'll just short it down again. I get it. I understand the cynicism. There's a long history of manipulation in the precious metals markets. But here's the thing. Even rigged games have limits. Even manipulated markets eventually break. Because the physical market is real. Supply and demand are real. And when the paper market gets too disconnected from physical reality, something snaps. That's what I think happened on Thursday. The banks threw everything they had at keeping silver below $90. They dumped contracts. They triggered stop losses. They coordinated with media to ignore the story, and it didn't work. Silver closed at $91.73. The suppression failed, and now they're on the wrong side of a gamma squeeze, and there's no easy way out. So, what happens next? Let me walk you through what I expect over the next 2 weeks. First, the continuation. Monday, January 20th, is a U.S. market holiday, Martin Luther King Jr. Day, markets are closed. But that's actually bullish because it gives the gamma squeeze time to build pressure. The market makers who need to hedge their delta can't do it on Monday. They have to wait until Tuesday. And by Tuesday morning, more options will have moved in the money over the weekend as dealers adjust their models. Tuesday, January 21st, I expect SIL to gap up at the open. Could be 2%, could be 5%. Depends on how desperate the hedging is. And if we gap up and hold the gap, that's confirmation that the squeeze is real. That's when the algorithms kick in. That's when the momentum traders pile on. That's when the retail FOMO wave begins. Wednesday through Friday, January 22nd through 24th, I expect volatile, choppy action. The banks will fight back. They'll try to shake people out. They'll engineer a fake breakdown. They'll coordinate negative headlines. Silver miners overbought. Time to take profits. The rally is over. Don't believe it. That's the playbook. That's how they always try to break momentum. But here's the thing. The fundamentals haven't changed. The earnings haven't been released yet. The gamma squeeze hasn't fully played out. Any dip next week is a gift. It's an opportunity to add to positions at better prices. Then we get to the final week of January. Earnings season. Hecla on the 28th. First Majestic on the 30th. And when those earnings hit, when the market sees the actual cash flow, the actual margins, the actual results, that's when the institutional money arrives. That's when the funds that have been sitting on the sidelines, waiting for confirmation, finally pull the trigger. And that's when this thing goes parabolic. Now, let me give you some historical context, because if you don't know the history, you won't recognize the pattern. In 2010 and 2011, we saw a similar setup. Silver went from $18 in late 2010 to $50 in April 2011. That's a 178% move. And the miners lagged for months. They just grinded sideways while silver was ripping higher. Investors were frustrated. They were saying, why aren't the miners moving? This doesn't make sense. And then, seemingly out of nowhere, the miners exploded. In a span of about 8 weeks from late February to late April 2011, some of the major silver miners went up 200%. Some of the juniors went up 500%, 800%, 1,000%. It was one of the most explosive moves in modern market history. And here's the key insight. The miners always lag. They always take longer to respond than the underlying metal. The institutions are slow. The analysts are slow. The retail investor doesn't even know these stocks exist until the move is halfway over. But when the catch-up happens, it happens fast, all at once, violent. And that's what I believe we're seeing right now. The beginning of the catch-up, the start of the repricing, the moment when the market finally recognizes that these stocks are trading at 2023 valuations while silver is at 2026 prices. Let me show you just how absurd the current valuations are. I'm going to use Hecla Mining as an example because they are the largest US-based primary silver producer and their financials are public and transparent. At $6.85 per share after Friday's close, Hecla has a market cap of approximately $3.8 billion. They're going to produce about 14 million ounces of silver in 2025 full year. At $94 silver with $32 AISC, that's $62 profit per ounce. 14 million ounces times $62 equals $868 million in annual profit from silver alone. They also produce gold as a byproduct, which adds another $150 million or so in profit. So total annual profit, over $1 billion, market cap, $3.8 billion. That's a price to earnings ratio of less than 4. Let me repeat that. Hecla Mining is trading at a PE ratio of less than 4 while printing billion-dollar annual profits. For comparison, the average PE ratio for the S&P 500 is around 22. Even if you say, okay, mining companies should trade at a discount because they're risky, fine. Let's give them a PE of 10. That's still 2.5 times higher than the current valuation. That would put Hecla at $17 per share instead of $6.85. That's a 148% upside just to reach a reasonable valuation. Not a bubble valuation, not a mania valuation. Just fair value based on current earnings. And that's assuming silver stays at $94. If silver goes to $110, the math gets even more ridiculous. At $110 silver, Hecla's profit per ounce goes to $78. Annual profit goes to $1.2 billion with a PE of 10. That's a $12 billion market cap. That's $21 per share. That's a 206% gain from current levels. This is why I'm so confident. The math is not ambiguous. The numbers are not subjective. These stocks are grotesquely, absurdly, comically undervalued relative to current silver prices. Now, let me tell you my personal battle plan for the next 2 weeks. And I want to be very clear. I'm not telling you what to do. I'm not giving financial advice. I'm just sharing how I'm navigating this based on 12 years of experience in these markets. Here's my trigger for adding to positions. If SEAL gaps up on Tuesday, January 21st, and holds the gap through the first hour of trading, I'm adding. That would confirm to me that the gamma squeeze is intact, that the momentum is real, that the institutions are still scrambling to hedge. I'm looking for a gap of at least 3%. Anything less, and I'm cautious. Anything more, and I'm aggressive. If we see a pullback during the week, if SIL drops 5% or more on any single day, I'm watching the $16 level. That's where we closed on Friday. If we dip back to $16 and find support, if we get a bullish reversal pattern, a hammer, a morning star, any kind of technical confirmation, I'm buying the dip. Because in a gamma squeeze, every dip gets bought. The forced covering ensures that there are buyers underneath. My stop loss is a close below $14.50 on SIL. That's about 10% below Friday's close. If we break that level, it tells me the thesis is wrong, the squeeze is over, something changed. And I'm out. I will not ride a losing trade hoping for a miracle, but as long as we're above $14.50, I'm staying long. My target for the next 2 weeks. I'm looking for SIL to test the 2025 highs, which were around $22. That's about 38% higher from Friday's close. Is that ambitious? Yes. Is it realistic based on the gamma squeeze dynamics and the upcoming earnings? Absolutely. And if we blow through $22, if we go into true parabolic mode, I'm looking at $26 to $28 as the next resistance zone. That's where I'll start taking profits. That's where I'll start scaling out, because I know from experience that trees don't grow to the sky. I know that parabolic moves always end in crashes, and I don't want to be the guy holding the bag at the top. I'd rather sell too early and leave some money on the table than sell too late and give it all back. Now, let me address the elephant in the room. The thing that nobody in the mainstream media is talking about. Why is this happening now? Why did the suppression break on January 16th specifically? And the answer, I believe, is liquidity. There's a massive liquidity shortage in the physical silver market right now. The premiums on physical coins and bars are at record highs. American Silver Eagles are trading at $15 to $18 premiums over spot. That's a 16% to 19% premium. In a normal market, premiums are $3 to $5. The mints can't keep up with demand. The dealers are on allocation. The refiners are running at full capacity and still can't produce enough metal to meet orders. This is a supply crisis, and it's spilling over into the paper market. The COMEX registered silver inventory has been bleeding for months. We're down to about 58 million ounces in registered vaults. That's the lowest level since 2016, and the delivery requests keep coming. Institutions, sovereign wealth funds, central banks, they're all demanding physical metal, and the exchange is struggling to source it. So what do you do if you're a market maker or a bullion bank and you're short silver futures, and you're realizing that you might actually have to deliver physical metal that you don't have? You panic, you cover your shorts, you buy back your contracts, you scramble to source metal from wherever you can. And that buying pressure pushes the price higher. And that's what I think broke on Thursday. The banks realized they couldn't suppress the price anymore without risking a delivery default. So they let it go, they stepped aside, and the price naturally found its equilibrium above $90, and once silver crossed $90, all those call options went in the money, and the gamma squeeze began. It's a perfect storm, and it's playing out in real time. Let me also talk about the international angle, because silver is not just a US story. This is global. China has been buying silver aggressively. The Shanghai Gold Exchange shows record premiums for physical silver in China. It's trading at $8 to $12 over the COMEX price. That's telling you that there's massive demand in Asia. India is buying. Middle Eastern sovereign wealth funds are buying. Everyone who understands the monetary endgame is accumulating hard assets. And silver, because it's more affordable than gold, is the accessible option for institutional buyers who want precious metals exposure, but don't want to pay $4,600 per ounce for gold. The global demand is insatiable, and the supply is finite. There's only so much silver mined each year. There's only so much inventory available for immediate delivery. And when demand exceeds supply, the price has to rise. It's not a matter of if, it's a matter of how fast. Now, let me give you another layer of analysis. The hedge fund positioning. According to the latest Commitment of Traders report, which shows the positioning of different types of traders in the futures market, the commercial traders, which are the banks and the market makers, are net short silver by a massive margin. We're talking about 120 million ounces net short. That's double the entire COMEX registered inventory. Think about that for a second. The banks are collectively short more silver than exists in the COMEX vaults. How does that even work? It works as long as nobody demands delivery. It works as long as people are content to trade paper contracts and settle in cash. But what happens when people start demanding physical? What happens when sovereign wealth funds say, we don't want cash, we want bars? The banks are trapped, and the only way out is to cover their shorts, and covering means buying, and buying pushes the price higher, and higher prices force more shorts to cover. It's a death spiral for the shorts, and it's a gold mine for the longs. Here's something else I'm watching. The gold to silver ratio. Right now, with gold at $4,652 and silver at $93.67, the ratio is 49.7. Historically, the long-term average is around 60 to 1. When the ratio is above 80, silver is cheap relative to gold. When the ratio is below 50, silver is expensive relative to gold. We're at 49.7. We're right at the threshold. And here's the pattern. When the ratio breaks below 50 and keeps falling, it often signals that silver is entering a mania phase. It means silver is outperforming gold. It means the speculative money is piling in. It means retail is chasing. In 2011, the ratio went as low as 32. If we see a similar move, if the ratio drops to 35 or 40, silver could go to $115, $130, even $150 while gold stays relatively stable. That's the kind of parabolic move that changes lives. That's the kind of move that creates generational wealth for people who are positioned early. And right now, you're early. Let me talk about one more thing, the media blackout. Have you noticed how quiet the mainstream financial media has been about this? CNBC isn't talking about it. Bloomberg barely mentioned it. The Wall Street Journal hasn't run a feature on the silver mining breakout. Why? Because it doesn't fit the narrative. The narrative right now is that the economy is strong, inflation is under control, the Fed is winning, everything is fine. Precious metals don't fit that story. Precious metals are a fear trade. They're a hedge against monetary instability. They're a vote of no confidence in the system. So the media ignores them until they can't anymore. Until the move is so big, so undeniable, so obvious that they have to cover it. And by then, the easy money is gone. By then, retail is buying at the top. By then, the smart money is selling into the hype. That's how it always works. So if you're watching this right now, if you're seeing this before the mainstream catches on, you have an advantage. You have information that most people don't have. You have time to position before the crowd arrives. Use it. Now, let me bring this all together with a 3-sentence summary. The post-OPEX gamma squeeze in silver miners is not a one-day event. It's the beginning of a multi-week forced covering rally driven by operating leverage, record earnings, and institutional short positions that are trapped. The math says these stocks should be trading at triple their current levels just to reach fair value. And the next 2 weeks are going to determine whether this becomes the face-melting rally I believe it will be. Here's my final word. I've been in these markets for 12 years. I've seen bull markets. I've seen bear markets. I've made money. I've lost money. I've been humbled more times than I can count. But I have never seen a setup as compelling as this. The fundamentals are screaming by. The technicals are breaking out. The sentiment is still skeptical. That's the perfect recipe. That's when the best trades happen, when nobody believes it, when the consensus is against you, when you're early and lonely. That's where fortunes are made. So stay sharp, stay disciplined, watch the levels I gave you, and if this thesis plays out, if the miners do what the math says they should, I'll be back with updates. Until then, trust the numbers, not the noise. The screen is lying, the earnings don't, and the gamma squeeze is just getting started. If you want the institutional framework behind today's story, the Silver Insider Toolkit is linked below. It's purely educational, but it shows you how to read the silver market beyond the price chart.